First payslip, first tax code, first pension. Nobody explains any of it. You negotiated the salary. You accepted the offer. You turned up on day one, excited and slightly terrified. And then your first payslip arrived, and it was nothing like the number you'd been promised. Deductions everywhere, lines with mysterious abbreviations, the number at the bottom looking significantly smaller than what you thought you were getting. Nobody warned you. Your contract said $30,000. Your bank received considerably less. Today, we're going through everything your first payslip is actually telling you, everything your employer won't automatically explain, and everything that will quietly affect your financial life for the entire length of your career if you don't understand it now.
Your gross salary is the number in your contract. Your net salary is what actually arrives in your bank account after all deductions. The gap between those two numbers is tax and contributions taken at source before you see the money. In the UK, the main deductions are income tax, calculated through bands where you pay nothing on roughly the first £12,500, then 20% on the next slice, and higher rates above that. And national insurance contributions, which fund the NHS and state pension entitlement. In the US, deductions include federal income tax, state income tax where applicable, Social Security, and Medicare. These deductions aren't money wasted. They fund systems you use and benefits you'll eventually receive.
Your tax code is one of the most important numbers on your UK payslip and one of the least understood by most employees. The standard code for a basic rate taxpayer is currently 1257L. The number indicates your tax-free annual allowance, so 1257 means £12,570 of income before you pay any tax. The letter indicates your circumstances. If your code looks different from 1257L, it's worth checking why, because a wrong tax code means you're either overpaying tax every month, which reduces your take-home unnecessarily, or underpaying, which means a tax bill arrives later. You can check and correct your code directly through HMRC's online portal.
Your workplace pension is the most underappreciated financial benefit of employment, and most people in their first jobs either ignore it or treat it as something they'll get around to eventually. That thinking is extraordinarily expensive over a career. In the UK, auto-enrollment means your employer must contribute a minimum of 3% of your qualifying earnings into your pension on top of your salary. You contribute 5%. That's an immediate 40% uplift on your own contributions, free money from your employer that disappears entirely if you opt out. In the US, many employers match 401k contributions up to a percentage of salary. Not contributing enough to capture the full employer match is leaving a meaningful portion of your compensation on the table every month.
The single most valuable financial habit you can build from your very first payslip is paying yourself first. The reason most people never build this habit is that they reverse the order. They spend throughout the month and save whatever's left at the end. The problem is there's almost never anything meaningful left at the end. Life expands to fill available money with extraordinary reliability. The solution is to move a set amount, even £50, even $25, even any amount at all, from your current account to a separate savings account on the day your pay arrives, before any other spending happens. Once it's in the savings account, it effectively doesn't exist for day-to-day purposes. This one habit, started from your first payslip and maintained throughout a career, compounds into a genuinely different financial life. If you graduated with UK student loans, your payslip will include a student loan repayment deduction once your income crosses the repayment threshold. Currently, 9% of earnings above £27,295 for Plan 2 loans. This comes out automatically through payroll, so you don't need to set up separate payments. What you do need to understand is how this affects your effective marginal tax rate, which for many graduates is higher than it appears, because every additional pound above the threshold is subject to income tax, national insurance, and student loan repayment simultaneously. In the US, federal student loan repayments aren't automatic from payroll. You need to set up and manage these separately, and missing them has real credit score consequences. Beyond salary and pension, your employment package almost certainly contains additional benefits that most new starters either don't know about or never get around to claiming. The Cycle to Work scheme in the UK lets you purchase a bike through a salary sacrifice arrangement, saving income tax and national insurance on the cost. Private health or dental cover, if offered, is worth significantly more than the premium cost suggests. Share save schemes, employee assistance programs with free counseling and legal advice lines, childcare vouchers, enhanced annual leave purchase options. Read your full employment contract and the company benefits portal carefully. The total value of your employment package is almost always higher than your headline salary suggests.
Your first proper job is the most powerful financial starting line you'll ever stand at, not because you have a lot of money, but because you have time. The compound growth available to someone who starts saving and investing in their mid-20s is mathematically enormous compared to someone who starts a decade later, even if they save more. The habits you build now, understanding your payslip, enrolling in your pension from day one, starting any level of saving from your first month, claiming the benefits you're entitled to, these don't just matter in isolation. They compound over decades into the foundation of genuine financial security. Start right. The earlier you build these habits, the less effort they need later. Subscribe to MoneyPatch. Small steps, big change.